Hi everyone, welcome to Week 2's lecture. This video has been created by your module leader Salah Hamad in order to help you understanding this week topic while you are studying it by yourself. Alright, let's dive into the core topic for this second week, the conceptual and regulatory framework of accounting. This is absolutely fundamental to everything we'll be covering in financial accounting too. Think of this as laying the groundwork, establishing the rules of the game, so to speak. This week, we'll be exploring the why and the how of financial reporting. We'll examine the underlying principles that guide the development of accounting standards. That's the conceptual framework, and then look at the actual rules and regulations that companies must follow, the regulatory framework. By the end of this session, you should be able to explain why we even need a regulatory framework in the first place. What problem does it solve? We'll then take a look at the International Accounting Standards Board, or the board as they're often called, and explore their standard setting process. We'll also see how they interact with national standard setters around the world. A key part of today's lecture will be understanding the conceptual framework itself. We'll be making an important distinction between principles-based and rules-based approaches to standard setting. We'll also define and discuss the fundamental and enhancing qualitative characteristics of financial information. Finally, we will define, explain, and apply recognition in financial statements of assets, liabilities, income, and expenses. And we will discuss the advantages and disadvantages of measurement alternatives. Now, to help you visualize the key topics we're going to cover today, let's take a look at this lecture at a glance slide. This diagram gives you a bird's eye view of what we'll be exploring. As you can see, we'll be focusing on the two main frameworks that underpin financial reporting, the regulatory framework and the conceptual framework. We'll delve into the regulatory framework, examining the regulatory system itself, the role of regulatory bodies, and the standard setting process. Then, we'll turn our attention to the conceptual framework, the foundation upon which accounting standards are built. Here, we'll explore the key qualitative characteristics of financial information, breaking them down into the fundamental characteristics, relevance and faithful representation, and the enhancing characteristics like comparability, verifiability, timeliness, and understandability. Finally, we'll touch upon the elements of financial statements and discuss how these elements are recognized within the framework. This diagram will serve as a roadmap for our discussion today, so let's get started. Now let's dive into the regulatory framework. As you can see from the definition here, this framework is essentially the system of rules, laws, standards, and oversight mechanisms that govern how things are done in the world of accounting. It's what ensures consistency and accountability. A crucial part of the regulatory framework is the standard setting process, particularly when we're talking about International Financial Reporting Standards, or IFRS. This process is overseen by a number of key organizations, and you can see their relationships illustrated in the diagram here. First, we have the IFRS Foundation, which is responsible for the overall governance of the IFRS standard setting process. Think of them as the top-level body. Then, we have the International Accounting Standards Board, or the board, which is the main body responsible for actually setting the IFRS standards themselves. To help ensure consistent application of these standards, we have the IFRS Interpretations Committee, or IFRIC. They step in when different interpretations of the standards arise, providing guidance to clarify any uncertainties. The IFRS Advisory Council acts as a forum for experts to provide advice to the board, ensuring that the standards are informed by practical experience and diverse perspectives. Finally, and this is a relatively recent development, we have the International Sustainability Standards Board, or ISSB. They're focused on developing global standards for sustainability reporting, an increasingly important area of financial reporting. So these are the key players in the IFRS standard setting process. Understanding their roles and relationships is essential for understanding how accounting standards are developed and applied globally. Now, a key question. Why do we even need a framework in the first place? Why can't we just have individual accounting rules and be done with it? First, a framework is needed to ensure that financial reporting is both relevant and reliable. This means the information presented must be useful for decision-making and also trustworthy. It's all about meeting the needs of the users of financial statements. However, accounting standards alone aren't enough. They can't cover every single possible scenario. That's why we also need legal and market regulations to provide additional control and oversight. Think of it as a layered approach to ensuring good financial reporting. As you can see here, a framework also acts as a safeguard for the entire financial system. It helps ensure fairness, transparency, accountability, and stability within the sector. Now let's turn our attention to the conceptual framework. It is essentially a set of underlying principles that guide how accounting standards are developed and applied. You can think of it as a kind of constitution for accounting. It ensures that there's consistency and logic in how financial information is prepared and presented. Without this framework, we'd have a chaotic and inconsistent system. As you can see from this diagram, the framework itself leads to two important areas: the qualitative characteristics of financial information and the elements of financial statements. We'll be exploring these in more detail shortly. The conceptual framework is truly the bedrock of financial reporting, the foundation upon which everything else is built. So the conceptual framework provides the why behind the what in accounting. It gives us the rationale and the logic for the specific rules and standards that we follow. The conceptual framework provides the why behind accounting standards. The regulatory framework provides the how to apply those standards in practice. The conceptual framework in 2011 identifies two main qualitative characteristics of financial information: fundamental and enhancing, the attributes that make information useful to those who are using it to make decisions. The fundamental qualitative characteristics are the absolute essentials. Without these, the information is basically useless. These are relevance and faithful representation. These are the non-negotiables. First, we have relevance. This means the information must be capable of making a difference in the decisions made by users. Relevant information has predictive value. It helps users evaluate past, present, or future events. And confirmatory value. It confirms or corrects prior expectations. The other fundamental characteristic is faithful representation. This means the information is complete, containing all necessary details, neutral, free from bias, and free from material error and omission. A material error can mislead users, making the information unreliable and irrelevant. These two, relevance and faithful representation, are the absolute minimum requirements for useful financial information. Please stop the video and read the scenario in order to identify which piece of information is relevant among the two. Let's move on to the enhancing qualitative characteristics. Remember, these improve the usefulness of information if it's already relevant and faithfully represented. Comparability allows users to compare a company's financial statements over time to identify trends, or to compare different companies to evaluate their relative performance. Verifiability means the information can be independently confirmed, either directly, like counting cash, or indirectly, like recalculating depreciation. Timeliness means the information is available when it's needed, in time to influence decisions. Outdated information is less useful. Finally, understandability means the information is presented clearly and concisely, taking into account the capabilities of the users. It's no use having accurate information if no one can understand it. Now, let's move on to the elements of framework. As you can see in the diagram, these elements are brought together in four key financial statements. The statement of financial position, also known as the balance sheet, shows what the company owns, assets, owes, liabilities, and the owner's equity at a specific point in time. The statement of profit or loss and other comprehensive income, or income statement, shows the company's revenues, expenses, and the resulting profit or loss over a period. The statement of changes in equity shows how the owner's equity balance has changed over a period. And finally, the statement of cash flows shows how the company's cash balance has changed over a period, broken down into operating, investing, and financing activities. These four financial statements, together, give a comprehensive picture of a company's financial health and performance. Here are the main elements, including assets, liabilities, equity, revenue, and expenses. In the coming slides, we will define these elements. Let's take a closer look at the statement of financial position, often called the balance sheet. This statement provides a snapshot of a company's financial position at a specific point in time. As you can see here, it's divided into three main sections. Assets. These are what the company owns. We further categorize these into current assets, which are expected to be converted to cash or used up within 1 year, like cash, inventory, and accounts receivable, and non-current assets, which are held for longer than 1 year, like property, plant, and equipment. Liabilities. These are what the company owes to others. Like assets, we split these into current liabilities, due within 1 year, like accounts payable and short-term loans, and non-current liabilities, which are due after 1 year, like long-term loans and bonds. Equity. This represents the owner's stake in the company, what's left over after liabilities are deducted from assets. Let's turn to the statement of profit or loss, often referred to as the income statement. This statement shows a company's financial performance over a period of time, such as a month, quarter, or year. It essentially tells us how much profit or loss the company has generated. The basic structure is quite straightforward, as shown here. We start with revenue, the money earned from selling goods or services. From that, we deduct the cost of sales, the direct costs associated with producing those goods or services, to arrive at gross profit. Then, we consider other operating expenses, such as distribution and administration costs, as well as finance costs like interest expense and investment income. Finally, we deduct income tax expense to arrive at the profit for the year, also known as net income. This profit for the year is a key figure that shows the overall profitability of the company during the reporting period. Let's look at the statement of changes in equity. This statement explains how the owner's equity balance has changed over a particular period. As you can see in the diagram, we start with the equity balance at the beginning of the period. That's the equity B/F brought forward. Then, we account for the various transactions that have affected equity during the period. These could include things like profit or loss for the period, which we saw on the income statement, owner's contributions, if any, owner's withdrawals, if any, Other comprehensive income, items that bypass the income statement. By taking these transactions into account, we arrive at the equity balance at the end of the period, the equity C/F carried forward. This closing balance then flows into the balance sheet as part of the company's overall financial position. Let's define the fundamental elements that make up the statement of financial position: assets, liabilities, and equity. These are core concepts in accounting, so it's crucial to have a clear understanding of what they mean. An asset is a, quote, present economic resource controlled by the entity as a result of past events. Importantly, an, quote, economic resource is a right that has the potential to produce economic benefits, meaning it can generate future cash flows or other economic benefits for the company. So it's not just physical things, it's the right to those benefits. A liability is a, quote, present obligation of the entity to transfer an economic resource as a result of past events. In simpler terms, it's something the company owes to someone else. This obligation stems from something that has already happened. Equity is the, quote, residual interest in assets after deducting all liabilities. This essentially represents the owner's stake in the company, what's left over for them after all debts have been paid. As you can see here, this reflects the fundamental accounting equation: assets equal liabilities plus capital, or equity. This equation must always balance, just like this scale. Let's define income and expenses. These definitions are a bit more technical, so pay close attention. Income is defined as, quote, increases in assets or decreases in liabilities that result in increases in equity, other than those relating to contributions from holders of equity claims. Let's break that down. Income makes the company richer. It either brings in assets like cash from sales or reduces what the company owes, liabilities. Critically, this increases equity. The exception is when owners invest money directly. That's a contribution of equity, not income. Expenses are the opposite. They are defined as, quote, decreases in assets or increases in liabilities that result in decreases in equity, other than those relating to distributions to holders of equity claims. So expenses make the company poorer. They either use up assets like paying rent or increase what the company owes, liabilities. This, in turn, decreases equity. The exception here is when the company pays out dividends to shareholders, which is a distribution of equity, not an expense. Now we come to the concept of recognition. Just because something fits the definition of an asset, liability, income, or expense doesn't automatically mean we record it in the financial statements. There are further conditions that must be met. An item will be recognized, meaning it will be formally recorded in the financial statements, only if it provides both relevant information. It has to be capable of making a difference in user decisions. Faithful representation. It has to be complete, neutral, and free from material error. However, even if something technically meets the definition of an element, we might not recognize it if there's a high degree of uncertainty about whether economic benefits will actually flow to or from the company. For example, if there's a very low probability of receiving payment on a sale, we might not recognize the revenue. This is all about applying sound judgment and ensuring that the information we include in the financial statements is truly reliable and useful. Let's talk about measurement. Once we've decided that something should be recognized in the financial statements, we then need to decide how to measure it. The IASB's conceptual framework identifies several different measurement bases, which you can see listed here. Historical cost. This is the most common and often simplest method. It means we record an item at its original cost, at the time it was acquired. So, if we bought a piece of equipment for $10,000 5 years ago, it would initially be recorded at $10,000. Current cost. This method values assets at what it would cost to replace them today. So, using the same equipment example, if a similar piece of equipment now costs $12,000, its current cost would be $12,000. Value in use. This method focuses on the future economic benefits an asset is expected to generate. It calculates the present value of the future cash flows expected to be derived from the asset. Fair value. This is the price that would be received to sell an asset or paid to transfer a liability in an orderly transaction between market participants at the measurement date. It's essentially the market price. Each of these measurement bases has its own advantages and disadvantages, and the appropriate basis to use depends on the specific circumstances. We'll be exploring these in more detail as we progress through the course. Let's focus specifically on the historical cost measurement basis and its advantages. As we discussed, this method records assets at their original purchase price. This makes it quite straightforward, and, as this diagram shows, it offers several benefits. First, it's easy to understand. The concept of recording something at its original cost is relatively simple. It's also objective and free from bias. The cost is based on a verifiable transaction, not on subjective estimates. This makes it straightforward to produce. There's less room for interpretation or manipulation. Because it's based on a transaction, the values can be easily confirmed using the original invoice or other supporting documentation. This makes it highly verifiable. Finally, under historical cost, gains are not recorded until they are realized through a sale or other transaction. This adheres to the principle of prudence, which we will discuss later. While historical cost has its advantages, it's important to be aware of its limitations. As this diagram illustrates, there are several key disadvantages. One major issue is that assets can become understated. Over time, the value of assets can increase due to inflation or other market factors, but historical cost doesn't reflect these changes. Relatedly, expenses may not reflect the current value of assets consumed. For example, depreciation based on historical costs might not accurately reflect the current economic cost of using an asset. Because assets can be understated, this can lead to profits being overstated. If depreciation is lower than the actual economic consumption of the asset, profits will appear higher than they truly are. Consequently, the calculation of return on assets can become less meaningful. Because the asset values are understated, the return on those assets will appear inflated. Finally, if a company were to make a full distribution of profits based on these potentially overstated figures, it could inhibit its future operating ability, as it would be distributing more than it has truly earned in economic terms. Now that we've discussed the limitations of historical cost, let's look at some alternatives. There are two main approaches to current value accounting that aim to address these shortcomings, as outlined here: constant purchasing power, or CPP, and current cost accounting, or CCA. Constant purchasing power accounting adjusts figures in the financial statements using a general price index. This helps to reflect the impact of inflation by restating amounts in terms of their equivalent purchasing power at a specific point in time. However, it's important to remember that this only reflects the general impact of inflation, not specific price changes for individual assets. Current cost accounting, on the other hand, focuses on the current value of assets. In the income statement, all costs are adjusted to reflect the current value of assets consumed during the period. And in the balance sheet, both inventory and non-current assets are shown at their current value. This provides a more up-to-date view of the company's assets and the cost of using them. These methods offer alternatives to historical cost, particularly in periods of high inflation, or when current market values are significantly different from historical costs. They provide a more relevant view of a company's financial position and performance, though they can be more complex to implement. Let's briefly recap some key accounting concepts. These are fundamental principles that underpin accounting practice. The going concern assumption means we assume the business will continue operating in the foreseeable future. Accruals accounting means we record revenues when earned and expenses when incurred, regardless of when cash changes hands. Prudence emphasizes caution and conservatism, especially when making estimates. The matching principle dictates that we match expenses with the revenues they help generate in the same accounting period. Materiality means we only record items that are significant enough to influence user decisions. Duality is the basis of double-entry bookkeeping. Every transaction has both a debit and a credit. And substance over form tells us to focus on the economic reality of a transaction, not just its legal form. These concepts are crucial for understanding and applying accounting principles. Let's discuss a crucial distinction in how accounting standards are developed: the difference between principles-based and rules-based frameworks. A principles-based framework, like the one used by IFRS, relies on broad guidelines and principles. It emphasizes professional judgment and allows for flexibility and adaptation to different situations. This approach is widely used globally, as IFRS is adopted by over 144 jurisdictions, including many European countries, Canada, Australia, and many emerging economies. The key is that accountants must use their professional judgment to apply these broad principles to specific circumstances. In contrast, a rules-based framework, such as US GAAP, generally accepted accounting principles, relies on detailed, specific rules and regulations. It mandates strict adherence to these rules, focusing on compliance. This approach offers more specific guidance, but can be less flexible when dealing with unique or complex situations. Principles-based systems offer more flexibility, but require more judgment, while rules-based systems offer more certainty, but can be less adaptable. Even with well-defined frameworks and standards, it's important to recognize that financial statements have limitations. They don't tell the whole story. Let's look at some of these limitations. First, financial statements are prepared for a wide range of users, each with their own specific information needs. It's challenging to create statements that perfectly satisfy everyone. So are financial statements adequate to meet all users' information needs? Often the answer is no, not entirely. There are also problems of classification, aggregation, and allocation. How we group transactions, how we combine similar items, and how we assign costs can all involve judgments that might not fully reflect the complexities of the business. Financial statements primarily focus on quantifiable financial data. Non-financial effects of events are often ignored or not fully explained. Things like employee morale, environmental impact, or customer satisfaction are often not captured, even though they can be crucial for a company's long-term success. A major limitation is that the information disclosed is primarily historic. While past performance is important, it doesn't necessarily predict future performance. Now let's consider who actually uses financial statements. These are the stakeholders in a business, those who have an interest in its performance and financial position. As you can see, there are many different stakeholders, both internal and external to the company. Internal stakeholders include employees, managers, and owners, who use financial information for day-to-day operations, strategic decision-making, and assessing performance. External stakeholders are those outside the company. These include shareholders and investors who need information to make investment decisions, lenders and creditors who assess creditworthiness, suppliers who evaluate the company's ability to pay, customers who might be interested in the company's long-term stability, governments and their agencies for tax and regulatory purposes, and the public, who may have a general interest in the company's impact on the economy and society. The key question, as posed here, is, what are their needs? Each stakeholder group has different information needs. For example, investors are interested in profitability and growth potential, while lenders are concerned with the company's ability to repay its debts. Understanding these diverse needs is crucial for preparing useful and relevant financial statements, and we will explore these needs in more detail later. Take a moment to think about this question, and I will share the answer later. To summarize our discussion on the conceptual framework, this diagram provides a helpful overview. It's structured like a pyramid, building from the why to the how. At the base, we have the objective, the core purpose of financial reporting. It's all about providing useful information to investors, lenders, and other creditors to help them make informed decisions about allocating resources. The second level bridges the gap between the objective and its implementation. This level consists of two key components, qualitative characteristics and elements. Finally, at the top level, we have the assumptions, principles, and constraints that guide how we actually apply accounting standards. The assumptions, like going concern and economic entity, provide the groundwork for the accounting process. The principles, such as revenue recognition and matching, dictate how transactions are recorded. And the constraints, like cost and industry practice, acknowledge practical limitations. Connecting all these levels are the overarching concepts of recognition, measurement, and disclosure. These concepts determine when, how, and what information is included in the financial statements. This framework creates a logical and consistent approach to financial reporting, ensuring that the information provided is useful and reliable for decision-making. Thank you so much for watching the video. See you soon.